For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
Welcome to the program. It is Managing Your Financial Future. I'm your host, Johnny Dean. Professor Rick Plum, certified financial planner, professional, and accredited wealth management advisor. I'm going to ask you this. As of this recording, some lottery somewhere is like the jackpot is a billion three.
Billion four.
Is it $1.4 billion? Yeah. And now by the time this airs, it may have already, you may have already won. But so I'm going to come on and I'm going to talk about how to win a $1.3 billion lottery and pay no income taxes. How about that?
Why do I think you're stealing a comedy skit from Mr. Steve Martin?
I'm not. This is I just you know how you yeah, first get a $1.3 billion. No, you know how you do that? You know how you win a $1.3 billion you win the lottery but you never claim it. That's the way to do it. See? You say, "Hey, $1.3 billion, but then I got to pay like $600 million in taxes, whatever it is." That's what we call the tax tail wagging the dog. Is that the deal? I don't know.
That particular stupidity would have been, yes.
Yes. Now, so what I'm leading to here, if you happen to look at the title of this particular episode, which is how you can pay zero taxes on $100,000 of income. I've always enjoyed doing this. Now, we haven't done this on this podcast, this particular topic, for a few years. I just wanted to bring it back to remind people of the fact that you have the ability to manage your taxes.
To some degree,
yes. Yes. In many cases, to some degree, you can do it if you happen to know what you're doing. And
that's usually the big issue.
Well, it is a big issue. But I think people don't necessarily always know that if you take money from this account over here, you're going to pay more in taxes than if you, say, took money from that account over there. And that's why we do, blending of buckets and all that stuff. But I want to go through this here. So I'm going to set up this scenario, and this is a very specific scenario, but it's done to illustrate this particular point. And I think you enjoy this sort of tax puzzle. Just before we went on, you were doing some math.
I love saving money, especially at the expense of the tax collector.
Oh, I tell you, there are very few things better than that. You don't get the money, and I do. How's that?
Yeah. I don't owe you nothing.
You'll get nothing and love it. Okay, so let's go over this scenario, and I'm going to have you, with these numbers, tell people listening how you can have $100,000 of income and pay no income taxes. And it all has to do with tax brackets and different types of tax brackets. So here's the scenario. We're going to say there's a retired couple, okay, married. They're both age 66, and they need $100,000 per year of income. And they've both decided to delay their Social Security benefits until age 70 because I guess they expect to live a long time. And at age 70, they've calculated their combined benefits will be, we'll call it $65,000. So they're 66 now. Going to wait till age 70 when they're going to get $65,000 of Social Security. So they have a very simple portfolio. Okay, they've got $600,000 in a 401k plan, and they've got $600,000 of what we'll call low basis stock in their personal accounts. This is stock they've owned for many years, and it's grown considerably in value. So there's a lot of gain in this particular stock. So that's $1.2 million, half 401k, half personal account. And that's it. They have no money in Roths. They have no bonds. They've got $600 in the 401k, $600 in their personal account. So again, they're a retired couple. They need $100,000 of income. So Professor Plum, if you would, please let everybody know how we can get the money, $100,000, without paying any income tax.
Well, and this does go along with the idea of ultimately creating buckets. But a lot of times people will come to us and say, here's where we're at. We're 100% growth and we're retiring tomorrow. And we know that's not quite right. But how do we get from point A, where we are today, 100% growth, to a more realistic properly structured bucket strategy without, just ripping the bandage off and killing us overnight. And so when we look at these kinds of things, we're always looking for ways to do things in a tax efficient manner. Now, if somebody's coming to me and they say, we need $100,000 a year, my first rule is don't waste good. You always look for the benefit that you can do something with. I know that starting this year, we have a very good standard deduction. The concept that you have thought about is we know that the top of the 0% long-term capital gain tax bracket is $96,700. So I can sell stock. Let's say I can sell $100,000 of stock that has a $5,000 basis in it and a $95,000 gain. And if that's the only thing I do this year on my tax return, I am going to end up paying 0 federal income tax. Nada. Zilch. Zippo. Why? Because we have a 0% long-term capital gain bracket on the first, if our income is $96,700 or less. Our total income is $96,700 or less. Well, like I said, if I sell low basis, $5,000 basis, $100,000 value stock, I create $100,000, I get to spend it, and it's all falls in that 0% income tax bracket. And that sounds very, very nice and very wonderful. And I could do that for the next 4 years. Mm-hmm. And I've funded my spending for the next 4 years very easily. Several problems with this, though. I'm in a stock that I'm selling for current cash flow for the next 3 to 4 years. That's a problem because stocks go up and down. Up is not the problem. Down is the problem. That $100,000 of stock I sell this year, it may go down in value next year, and I have to sell what was 120, 130 just to get the 100 that I wanted. Now, the good news is I won't have as much tax to pay because I lost money. I don't like to lose money. So how do I do this in a manner that is more realistic of time horizons, investment philosophy, what we need to do? And so what I would look at is going back to the first rule, never waste good. We have a very good, large standard deduction this year for people age 65 and older. You said this couple was 66.
Uh-huh.
I would take $46,700 from my 401k this year, and I would put that on my tax return. And in addition to that, I would sell stock equal to $96,700 of gain. So in my first example, that was roughly $100,000. So I just create, and by the way, how much in tax did I create by taking $46,700 out of my 401k and selling stock worth $96,700?
Now keep in
mind,
mind,
federal income tax bill. Drum roll, please. 0. Nada.
And this is why we need to explain this now. You have just taken 130 whatever thousand,
$145,000 basically, 140 some $1,000.
Yeah, 100. Well, yeah, 90. Yeah, and you've paid no income tax. You took 40 whatever it was,
46,700 out. That's wiped out by the standard deduction, so I don't pay any tax on that. Only leaving 96,700 on the tax return as taxable income. But that taxable income is all comprised of long-term capital gain, which is taxed in the 0% long-term capital gain bracket.
Everybody follow that? I mean, it's can be a little bit.
Now, why did I sell 96,700? Well, we're a little bit later in the year right now, so I just created almost 2 years worth of my cash flow. I needed about $50,000 a year from the personal portfolio. I sold, $100,000, so that gives me this year's cash flow and next year's cash flow. But I don't like just a 2-year buffer on cash. So because we're later in the year, I can do that this year, and I can do it again next year, which gives me 4 years of bucket number one cash because I'm not spending it. It's actually 5 years, but I've got it all scheduled out, and then I just keep doing this to try to build my bucket number one. Maybe not immediately, but over the next 2-3 years. I'm only going to be able to do this for 4 years because at some point I'm going to run out of long-term capital gain to sell, and this excessive standard deduction does sunset, at least under current law, after 2028. So we've got 4 years of it. But there are ways to look at things and say, how do I get from point A to point B without completely screwing up things? Now, hopefully in that $600,000 portfolio that the people had, there was something that didn't have quite as much gain as what I just mentioned. Not everybody has 95% gain in their portfolio. That was an extreme example. So, but if I had 50% gain, that just gives me a lot more available cash to create from the sale. So I'm trying to create 96,700 of gain. But if I've got a 50% gain, 50% basis, that means I could sell $183,000 of value, and I can fund my bucket number one very quickly. And it comes into play really nicely. Now, looking forward into the future, if I'm spending this, I'm spending it down pretty quickly. I mean, I'm spending $100,000 out of $1.2 million. That's better than an 8% distribution rate. Now, the people that talk about the 4% rule have just rolled over in their graves. And the only people that talk about the 4% rule being that much of a rule are in their graves. They're dead. They're gone.
I wonder where you were going with that. Now let me just for just a moment. I know you're throwing a lot of numbers out there, and for people listening, this can get whoa, wait, what we've done, and you're doing this between age 66 and age 70. You're taking
46,700.
Yeah, okay, 46,000
this year.
plus. Yeah, this year out of your 401k, and you're just taking that out. And you're not paying any tax on it, as we said, because that's the standard deduction for a married couple currently age 65 and older. Then you're taking another 96 plus out of the personal account.
I'm taking 96,000 of gain.
Yes, out of gain. Out of that, and then you're paying no income tax on that because capital gains taxes, you can take up to 96,000 plus of capital gains and pay no income. It's a pretty good deal for people with capital gains. Now, what's happening?
And it can get me to where I need to be on a more appropriate investment strategy by freeing up this capital to be reallocated away from growth and into more systematic bucket number one type investments. 401k is easy to redeploy because there's no tax on selling and buying inside of 401k. It's the personal money that is difficult. And we want to be able to, what you said at the very beginning of the podcast, blend these buckets so that we don't have to pay taxes.
What you're doing, you're taking more money out than you actually need to spend. But
in this example, yes. Now, if I'd done it the old-fashioned way and I just sold $100,000 worth of stock, I could do four plus years with that, maybe 5 or 6, but then my Social Security kicks in, and then ultimately I haven't touched the 401k that was $600,000. Now it's $800,000 or $900,000. The required minimum distribution kicks in. The required minimum distribution plus the little bit of capital gains that I still have left, plus the Social Security creates a taxable event across the board that I'll never get out of.
Yeah, and so that's the reason for doing that. You're lowering you're spending your taxable your qualified accounts.
I'm spending my tax deferred accounts to some degree in a very and I hope you'll agree with this, a tax efficient manner. Spending zero money on taxes is about as tax efficient as you can make it. I like that.
Well, and you said don't waste good. And so that's one of the other reasons. There are a couple of benefits for doing this the way you're doing it. You're not wasting good. You're using as much of your 0% capital gains tax bracket as you can. You're using much of your 0%, your standard deduction, which is basically a 0% tax bracket as you can. And you're getting the money out of the pre-tax area, and you're also lowering your potential RMDs. So there's a lot of good for doing this. So I just want to make sure people understand with all these numbers that you're throwing out how this works.
Right. And moving forward, because we're taking, money out of the 401k, we're taking a decent distribution of the 401k as well. We're taking it's $600,000. We're taking 45,000 out. It's a decent, that's more than 4% as well. But what happens is, let's say that the 401k overall is bucketized properly. We're taking the money out, and it earns 4 or 5% overall. Some of it's in growth, so it's earning nicely. Some of it's in safety, so it's not earning anything more than 4%. After 5-6 years of doing this, we still have, maybe $450,000, $500,000 in the IRA, rather than $800,000 or $900,000.
How could that be 401k just
in the 401k or the IRA? How could that be good, Rick? Why wouldn't 800 be better than 400? Well, because when my required minimum distribution does kick in at 73, it's going to be about $20,000. And if I'm taking this 401, the $600,000 of personal money and redeploying it over time, and it's got a little bit of growth to it and everything, it'll be worth $300,000 or $400,000 at the end of 6 years as well.
Mm-hmm.
And that means I will be able to, when Social Security, 4 years from now, Social Security kicks in at $65,000, I don't need $100,000 from the portfolio anymore. I need $35,000 plus some money for inflation.
Yeah, and this is because the Social Security has kicked in, and this lowers the pressure on your portfolio quite a bit, if I can use the word pressure. Now,
I'd really like the portfolio combined between the 401k deferred money and the personal money to still be in the $700,000 range. Now, I just went through the math a minute ago, and there was going to be $400 to $500 in the 401k and $300,000 to $400,000 in the personal account. Combine those together, I've got more than, I got $900,000 left over. And why does that matter? Because now I am looking at more of the 4 or 5% distribution rules, guidelines really, and I'm well within tolerance of taking money out of those. So for the rest of my life, I'm going to have a decent investment philosophy. Now, what is my tax situation going to look like? My required minimum distribution, call it $20,000, plus my Social Security is $65,000, plus another $15,000 from the investment portfolio. Now, that $15,000 isn't creating much in the way of taxes. There's only $300,000, $400,000 left, only, as I say, which is earning some interest and dividends and capital gains. But any interest and dividends, ordinary dividends that are added to that, I'm still, even with a lower potential standard deduction of only $34,000, give or take, in 2029 and beyond, I'm still, how much is my distribution from my IRA? $20,000. I still have $12,000, $13,000 of room in the ordinary income tax bracket to pay zero income taxes. And I've got another $96,000 or more by that time of room in the capital gain qualified dividend area to pay zero taxes on my personal account.
Yeah.
So the next 4 years, I'm paying no taxes. And based on, unless something really unusual happens, like you can figure out a way to turn the $600,000 personal portfolio into $6 million in 4 years. I'm not saying it's impossible, but that's impossible. But unless something like that happens, you're never going to pay taxes again in the rest of your life, except for the state that you may live in. Now, that's a different game.
Well, I tell you what, if you turn 600 into 6 million.
If you turn 600 to 6 million, you're not too worried about too many things anymore.
I'll pay the taxes. That'll be
darn it.
Fine.
Oh,
kind of like winning the lottery. You got to pay taxes, a little bit of taxes.
Winning the lottery, California, a California resident pays less in taxes than an Indiana state resident when they win the lottery.
Is that well? Okay, interesting. Don't say that too loud. I mean, for your sake,
No, California doesn't listen to me. I mean,
they don't listen to you. Oh, okay. Well, so you see what happens, and here's the thing: an important point that's coming out of this as well is that once you hit required minimum distribution age, which for some people now is 73, it could be as high as 75 in a few years. For you and me, yeah. But you lose a little bit of tax management control. You don't lose it all, but you do potentially lose some tax management control, depending on how big your required minimum distribution is.
Well, for this couple between now and age 73, we have total discretion on where to get the money. How much from IRA, how much from personal account. We could take it all from the IRA, 401k, I should say, at this point, because you haven't rolled it to an IRA. We could take it all, but that was going to create some taxes. If I take $100,000 out, 54,000 of it is taxable. You figure you're going to have a $5,000 federal income tax bill by doing it that way. And you've deferred the capital gain, but at some point, if you're taking 100,000 out of 600,000, actually 105,000 to be able to pay the taxes, you're going to whittle down that 401k really quick. And then you're ultimately going to have to sell the stock anyway and pay the capital gain when you're taking your Social Security, which will then subject some of the Social Security to taxation. And it's going to be a nightmare. It's not a nightmare, but it's not going to be as fun. The way the way you presented it, the way I described it, we ain't paying nothing, baby. Zero in tax bills forever.
And that's, I like that too, and that's really the point. And
that's the fun of tax planning. You talked about it. That people are like taxes. Oh my God. Isn't that a 4-letter word? How does it come out that it's not 4-letter word? It's just the worst thing in the world. It's the worst thing in the world when you let it affect you and not help yourself with it. But if you can manipulate it and get the best of it, that's where it's fun.
Yeah, and sometimes you can hit a sweet spot like this. This example we gave obviously led into this extremely, well, I would say this ideal tax management situation. Now, not everybody, not everybody has that situation. Some people have a lot more in Roth, or in
IRA
type money, and then a lot less in personal. So you may not be able to quite do it this way, but the illustration is that you can, to whatever degree is possible, manipulate your tax bill such that you're paying less. And it all comes down to where you're taking the money out of and doing it before you're required to do so. That's why this stuff is important to think about well before your required minimum distribution age. We've said for a long time that the conventional wisdom is that leave your IRA money alone. Don't ever take it out and pay taxes on it until they require you to. But you just gave about 4, 5, 6 reasons why that's not necessarily, why it's a bad idea.
Well, the increase in the required distribution age from 70.5 5 years ago to 72, 73, and then ultimately now to 75 for anybody born in 1960 or later was not done as a benefit to you. They did not raise that to benefit you. People complaining about the RMD are the people who don't need the RMD. People complaining about the RMD are the more wealthy individuals. Most people are taking money out of their tax-deferred accounts to live on, and just in doing that, they're pretty much satisfying, if not more than satisfying, the required minimum distributions, whether it was at 70 or at the other ages that we've been able to come to. But remember, they did that increasing of the required minimum distribution age in combination with taking away the survivor options. Stretch option. Now there's a 10-year payout on the survivor option. Why would they allow the wealthy people that don't need their IRAs to let them grow for as long as they can, but then slam the beneficiary? Taxes. They did it to raise taxes. They didn't do it to help you. They did it to help them. Yes, I'm a cynic. I don't like Congress. It's not a political statement. I hate them all.
That's the across-the-board statement right there. Well, I mean, we won't get into all of that, but you've got a point, and it's, of course, the question is going to be not to get off topic here, and I won't, but will that standard deduction will they chop it off in 4 years?
Will it sunset in 4 years? Who knows? But in my example, I assume that it did sunset, and we're still going to be okay in this example.
And what you've done, this is the other part of this that I like, is that what you've done is not only are you using the tax brackets and not wasting good, as you said at the top of the episode, but you're also setting up your buckets in a kind of a sneaky, non-sneaky way by taking more than you need and then setting up your bucket one for future distributions. I really think that's kind of brilliant right there.
Yeah, you don't necessarily have to do it all at one fell swoop. Just boom. You're 100% stocks 1 minute, you're bucketized the other. And so we can morph into this. Now, it's a little bit better to morph into it a little bit slower than what I did, but you can make it work to your advantage without, undue hardship with taxes. Now, in the example we played with, I did assume that the $6,000 per person annual deduction did sunset. And we still didn't owe any taxes. But that also means that if it does get extended somehow, we just have more room to do even more wonderful things, like continue exactly like we were doing before, but don't waste good. Do Roth conversions of $12,000 a year from the IRA. So because now we have more room in the 0% income tax bracket, we can do that and build up a Roth for no tax money going forward.
And even if you're, and we talk about using the bracket. This is really good stuff. We talk about using the bracket. 0% bracket. There isn't one, but there is because of the standard deduction. If even if you're in a 12% tax bracket, and you're not going to go lower than that, that's just what you're in. I mean, it might make sense to use up your 12% or whatever bracket you're in potentially.
Assuming the 12% is a real 12%.
Mm-hmm.
Now, with $65,000 of Social Security,
well,
you want, when you hit the 12% bracket of taxable income, you have not hit the 85% threshold on the taxability of your Social Security. So you're still in that phase and ramp up speed zone of just nailing your Social Security. So for every dollar that you're in the 12% bracket, you're not paying $1.20 on a $100 or whatever it is in $10 distribution. For every dollar you show, 85 cents of Social Security comes in as well on the taxable column. So you're paying 12% on $1.85. So your real effective, realistic bracket at that point is 22.2%.
Now, is this still true even with the rebate or whatever you want to call it of Social Security taxes for 65 and older?
The calculation to determine the Social Security taxability did not change in any way, shape, or form.
Yep.
Now, the question I don't have an answer to yet, because I haven't seen how they're going to do it, is does that new $6,000 and $12,000 for a married couple deduction reduce my otherwise ordinary income, my provisional income? Does it reduce the overall income for the Social Security calculation? I don't know how they're going to do that, but they might be able to. And if that case works, then that's just even a better plus. But where they're going to put it on the tax form, yeah, we need that, is going to matter, because a lot, like if we're determining the IRA provisional income to determine whether or not we have income, certain deductions don't count when finding the modified adjusted gross income for that. And so are they going to treat this $6,000 standard deduction as a reduction to the provisional income, or are they going to treat it as not part of that? And if that's the case, then it's not that big of a deal. Well, it doesn't help that much.
And for those who have no idea what Professor's talking about,
this is a very complicated part of the tax form.
Just sit back and say, well, what I'm sure he knows what he's doing, and it's actually a very good question. But don't worry too much.
We haven't received any guidance yet from the IRS on how it's going to be done. And the reality is, Congress passes these rules, and none of them have done any accounting, and none of them have ever worked for the IRS. Probably none of them have ever actually done their own taxes. And then it's up to the IRS to tell us how it's going to work and where it's going to work.
Yeah, it's just you guys sort it out. Here's a new law. You guys figure out how to enforce it or not. I mean, heck. Well,
give us some. Well, it took 4 years to give us guidance on the new 10-year beneficiary IRA beneficiary rule.
And there have been others that I think took even longer than that. I'm trying to remember off the top of my head, but yeah. So we don't know everything yet. But what we do know is that this tax management technique of using $100,000 of income, it works. If you happen to fall into this example that we gave. But again, as I said, this illustrates, even though most people wouldn't fall into those exact categories, this illustrates how you can actually manage your taxes. And it's one of the fun things of one of the fun elements of financial planning. But let me just stress again, you got to know what you're doing.
Now, in this case, we were able to do some serious, and when I get to zero tax zone, that to me is serious. Not everybody is going to get to a zero out-of-pocket expense for taxes, but there most likely is some amount of efficiency that you can do by knowing what's going on in your tax law.
Yeah, you could be leaving money on the table. Oh, not on the table. You could be paying.
You could be giving the IRS more money than you need to.
And it's very rare that they write back to you and say, if you'd done it this way, you could have saved some of that money. So I'll tell you what we're going to do. We're going to refigure your taxes so that it's the most efficient amount, and you're going to pay as little as you're actually required to do.
Are you kidding? Get a word saying I've received the notices that we're changing your tax because of the following, and I've gotten a hold of them and said, you're wrong. You put it back the right way and give me back all my refund or whatever. And I've shown them the documentation. I've shown them their IRS publications. I've showed them their tax law, and they send me the money that they owe me, that they said they didn't owe me. But they never said sorry. They never said, oh, by the way, you were right. They never said, we're sorry we were wrong and put you through the stress of getting that Treasury bill, the bill from the Treasury. That thing sucks when you get it in the mail. You get something in the mail that says U.S. Treasury, and you know it's from the IRS, and you're thinking, oh, God, you know you did it right, and you're thinking, what did I do wrong?
Okay, but I that's probably true. However, if I worked in the IRS or the franchise tax board or any of the state tax boards, if I worked for them and I saw a letter from Professor Plum, I think I might get a little shaky. I mean, if just personally speaking, because
I'll make a deal with them. They don't send me one. I won't send them one.
That's not just for you. Let's all do that. What do you say? These are tax management techniques that are really specialized, and these are the kinds of things that the people at Lucia Capital Group do every single day. I mean, every single day. These are the kinds of things that they work on. Why? Because they like it. Why? I don't know.
It's a mental issue.
It's, I guess, but they somehow just be glad they enjoy doing it and get a lot of kick out of it, especially when you could pay no taxes. Give the advisors at Lucia Capital Group a call if you need your portfolio looked at, you want a tax management technique or something to help you pay potentially less in taxes. 800-644-1150, the number at Lucia Capital Group. You know it by now, but I'll give it to you again. 800-644-1150. Also go online, luciacap.com, LUCIACAP.com. You can find, I believe we had a somewhat older video on this particular thing with topic with some graphics and stuff, but the idea is still the same. You'd find that at luciacap.com. Also find our Social Security guides. You can find our estate planning guides, our retirement planning guides, retirement income buckets, all that stuff at luciacap.com. You know, we used very quickly because we're about out of time, but we used $100,000 of income on this. You could actually use this technique, for more money than that. And the larger the tax brackets get, the more you can actually earn by doing this.
Yeah, but on the other side, I saw a recent article that said the average middle-class retiree spends $5,400 a month.
Spends $5,400.
Right. That's only $65,000 a year. Not $100,000.
Yeah. I guess, that's fine. For some reason, I thought it was higher than that, but that's the average across everywhere. And that includes some of the 90-year-olds that are in there.
There's not that many 90-year-olds compared to the number of 65-year-olds. Okay?
Exactly. Yeah. So, but anyway, interesting statistic. Don't forget to subscribe to this podcast. Oh, if you hadn't, you know what, you folks, if you didn't know about this podcast and you hadn't maybe subscribed or you just stumbled on it, if you did not know that this episode existed, look what you would have missed. I mean, my gosh, you probably want to go back and listen to this again. It was that informative. Don't ever miss an episode. Apple Podcasts and Spotify. Those are the two places you can find us. Or I think we're also available at luciacap.com if you just want to listen and go to the website and find our podcast there. My thanks to you, Professor Plum. I knew we'll talk about this again if we ever get clarification on the standard deductions.
When we get clarification, we're going to have it by the time we file our tax return next year.
That's true. Yes, in 2026. Yeah. Well, maybe we'll revisit this and see where we are. But at least know that you can manage your taxes that way. My thanks to you, Professor Plum. Brilliant as always.
Thank you, sir.
Thank you. For Professor Rick Plum, certified financial planner, professional, and accredited wealth management advisor, I'm your podcast host, Johnny Dean. Thanks for listening. Managing your financial future. We shall talk to you again next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. This material was gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice, and its accuracy cannot be guaranteed. Stock investing includes risk, including fluctuating prices and loss of principal. No stock investment strategy or risk management technique can guarantee return or eliminate risk in all market environments. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal
withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you're required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and the 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Bonds are subject to market and interest rate risk if sold prior to maturity. Bond values will decline as interest rates rise. Bonds are subject to availability, change in price, call features, and credit risk. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC.